In this video, we're going to talk about how to buy your first investment rental property. Before starting, do like the video and subscribe to this channel for future updates. A study of asset returns over 145 years in 16 developed countries found rental properties outperform stocks. But how can rental properties perform better than stocks with lower volatility and risk? Don't higher returns mean higher risk? Well, the answer is simple. There's a higher barrier to entry to invest in rental properties. Buying rental properties requires money and skill. Anyone can throw $100 into an index fund. No minimum cash requirements, no education required. It's one of the great advantages of investing in equities despite their volatility. But rental properties pose two huge challenges to new investors. They require more money to purchase and they require more skill than index fund investing. Yes, but you can utilize techniques to avoid real estate investment down payments. No money down rentals. Buying a rental property with no money down is a common question. Every investor has asked this question: how to acquire a rental property with no money down? How can you reduce or even eliminate the down payment you need to buy your first rental property? Number one, consider house hacking first. House hacking is the easiest way to get a rental and free housing. Traditional home hacking involves buying a small multifamily 2 to 4 units, living in one and renting off the others. Your neighbor's rent covers your mortgage and other housing costs, making it free. When you move out, you keep it as a rental property and your cash flow improves. This helps your down payment. Owner-occupied properties have lower down payments than investment properties. Borrowers are less likely to fail on mortgage than a rental property loan. FHA allows a 3.5% down payment with a 580 credit score. If your credit score is below 580, you should pay down payments before buying a rental property. FHA isn't the only choice. Other conventional mortgage programs need no money down. Conventional loans have lower interest rates and lower monthly mortgage payments. Compare interest rates and loans on Credible, then talk to at least 3 traditional mortgage lenders or brokers. House hacking isn't limited to multi-unit houses. Try these more free housing hacks. Number 2, the BRRRR Method. The BRRRR technique costs upfront cash but returns it. Buy, remodel, rent, refinance, repeat. Purchase rehab loans need a down payment to acquire fixer-uppers. You renovate the property using a purchase rehab loan, try Kiavi or Lending One for the initial renovation loan. After renovations, refinance the property with a long-term landlord loan, try Vizio, and withdraw your original capital. The new landlord loan is based on the property's after repair value, ARV, not its original price. If you have enough equity, you can refinance to fund your down payment. If you can't afford a down payment, try borrowing it from family or friends. Beginners adore the notion of 100% financing. However, the BRRRR technique is ideal for experienced investors due to higher risk. If you're a beginner, start with low-risk tactics. Number 3, seller financing. No one requires a financing program. Sellers may finance the property, allowing you to negotiate financing terms, including no money down rentals. This works effectively for homeowners without a mortgage or sellers who inherited a house. Perhaps the vendor can afford to perform needed repairs. They're often happy to accept monthly payments in exchange for a rapid settlement and no real estate agents or commissions. Many sellers provide owner financing. It's a good method to buy your first rental with no money down. Number 4, assume the seller's mortgage. Even if the seller won't directly finance the home, you may be able to work something out. You can offer to buy the seller's mortgage. You take their probably low-interest loan, leaving you with the difference. Beware of the due-on-sale condition in the mortgage. When using conventional finance, lenders won't let you borrow the down payment. You must invest. You're not borrowing a buy mortgage, you're merely assuming the current one and paying the seller any difference. You can pay any way you like. Friends and family could lend money, credit card or personal loan, or borrow from the seller. Number 5, negotiate a seller-held second mortgage. Say you locate a lender prepared to fund 80% of a landlord loan's purchase price, but you don't have 20% down. Money from where? Another seller. Before negotiating with the seller for a second mortgage, check with your primary lender. Vizio and Lending One allow it. FHA loans prohibit seller-held second mortgages. Number 6. Collateral-based lenders, flexible on fund sources. Conventional and FHA lenders follow rules. No one can lend you money to acquire a rental property with no down payment. Not all lenders are picky about down payments. Landlord lenders and hard money lenders lend based on the property, not the borrower. As long as it's not from them, they don't care where your down payment comes from. Whoops, they'll lend at a lower LTV requiring a higher down payment. You won't need PMI. Longer-term mortgages and hard money loans require a 20% down payment. Hard money loans are short-term purchase rehab loans, while portfolio loans are long-term landlord loans the lender holds rather than selling. Most lenders offer both sorts. Consider Patch, Kiavi, or Vizio. You can borrow the down payment from a landlord or other lender, friends, family, credit cards, personal loan, seller, retirement account, everywhere. Some investors take out a personal loan for the down payment months in advance, then borrow a purchase rehab or landlord loan from Vizio when they find a decent bargain. Their checking account has the down payment. Number 7. Gap lenders. Gap lenders fund your next property's down payment. They offer hefty interest and fees to cover their significant risks as second lien lender. They rarely charge interest or put a lien on the property. In exchange for the down payment, they take half ownership interest in the property. You get what you paid for or don't. Some gap money is better than none. If you can't afford a good deal, consider a gap lender. Tony Xavier's Gap Funding Solutions is credible. Rich uncles may charge less than professional gap lenders. Number 8. Private money from family and friends. As you gain real estate investing experience and a track record of accomplishment, others will lend you money. Private money lenders can be negotiated with friends, family, and acquaintances. A real estate couple I know borrows money from me at 10% interest. Why do they pay high interest? First, I didn't charge any charges or fees at the beginning of the transaction, saving them thousands compared to a typical loan or hard money loan. Second, I made the loan interest only with an open repayment date. Everyone you know could lend you money. Just build trust and credibility. Doing that and buying a rental property with no down payment will be easy. Number 9. Partners. Friends and family are potential down payment providers. Who says you can only borrow money? They might wish to invest with you. You have no down payment but real estate investing experience or the willingness to develop it. Your acquaintance has a down payment but no time to learn about renting. Heaven send. You offer the expertise and sweat for the down payment. You probably know someone looking to invest in real estate. Passive income is great. The best passive investment is a rental property. Number 10. Credit cards. We already covered the benefits, downsides, risks, and rewards of using credit cards to acquire rental properties, but they're worth mentioning again. In a perfect world, you use the unsecured business credit cards during a 0% APR term. Using a company credit concierge service like Fund and Grow helps you obtain $150,000 to $200,000 in credit lines and cards on average. They also show you how to withdraw money for 2.5% instead of the standard 3 to 4% cash advance cost. Since you have fast cash, you can make monetary offers. Funding is more flexible than a mortgage, and reward points generally offset cash advance expenses. Imagine buying a $100,000 rental property with an $80,000 landlord loan and a $20,000 down payment. You withdraw $20,000 with your credit card, pay a 2.5% wire advance fee, and get 1.5% back in incentives. You pay 1% to withdraw money. That beats a mortgage. Instead of a mortgage, use credit lines and cards. For interest, pay down the balance quickly. How quickly can you pay off the credit card? Within a few months is a good answer. If you answered a few years, rethink. Number 11. HELOCs and second mortgages on your residence. Borrowing against your home is another way to buy a rental property with no down payment. HELOCs are useful here. You get a line of credit against your home equity and pay it back with rental income. Investment properties are eligible for HELOCs. In the case above, you borrowed $80,000 to acquire a $100,000 rental property. A HELOC is cheaper than credit cards, at least for rates. The lender will need to run a title history on your home and will almost definitely incur trash fees. HELOCs keep going. You can keep buying rental properties, withdrawing money, and repaying it. Second mortgages, home equity loans, are less flexible but can cover a rental property down payment. Multiple lenders provide second mortgages on Credible. So, what'd you think of the video? Do let us know in the comment box below. Please like the video and subscribe to our channel for future updates.